The United States owes $36 trillion. China owes $15 trillion. Japan owes $10 trillion. Every major nation on Earth is drowning in debt. Total $317 trillion. But here's the question nobody asks: if everyone is in debt, who is the creditor? Debt is a zero-sum game. For every borrower, there must be a lender. If the world owes $317 trillion, someone owns $317 trillion in claims on everyone. This isn't about conspiracy. This is about understanding the largest wealth transfer mechanism in human history, one that operates in plain sight, embedded in every transaction. The answer changes everything. Let me show you a number that should fundamentally reshape how you understand the modern economy. $317 trillion. That's 330% of global GDP. Every dollar produced on Earth for an entire year doesn't equal a third of the total debt. We would need 3 years of global output with zero consumption, zero wages, zero spending just to pay it off. But here's the paradox that haunts every economist who looks closely enough: that debt cannot be paid off. It was never designed to be paid off. The system is built so that debt grows faster than the money available to repay it. And understanding why reveals something most people never consider. If the United States owes $36 trillion, someone owns $36 trillion in claims on the United States. If global debt is $317 trillion, someone holds $317 trillion in assets. Every liability on one balance sheet is an asset on another. So who sits on the other side of the ledger? The answer isn't a single person or a single institution. It's a system, a mechanism designed centuries ago and refined ever since. A mechanism that transfers wealth from the many to the few, invisibly, legally, every single day. Jennifer Caldwell still remembers the exact moment she understood she was trapped. She was 43 years old, sitting at her kitchen table in suburban Ohio at 2 a.m., spreadsheets covering every surface. Her mortgage, $287,000 remaining. Her husband's student loans, $84,000. Credit cards from when he was unemployed, $31,000. Car loans, $42,000. She added it up, $444,000 in total household debt. She earned $78,000 a year as a hospital administrator. She would pay approximately $23,000 that year in interest alone, before touching a penny of principal. 29% of her income flowing to creditors she'd never met for the privilege of owning things she thought she owned. "I work until 10 a.m. every day, just to pay interest," she told her sister the next morning. "Then my actual life begins." If you could see a visualization of money flowing through the global economy, you would see something striking: rivers of interest payments streaming upward from billions of individual households and businesses, converging into increasingly narrow channels until they pool in accounts held by a remarkably small number of entities. The flow never reverses. It only accelerates. Here's a question worth sitting with: if debt is how most people access homes, education, and transportation, and debt requires interest payments, and interest payments flow upward to creditors who designed that system and who benefits from it. What most people get wrong about global debt is this: they think it's a problem to be solved. They think governments are trying to reduce debt, that economists are searching for solutions, that the system is broken and needs fixing. The system isn't broken. It's working exactly as designed. The debt is not a bug. The debt is the mechanism. Marcus Webb made a different choice. He was 51 in 2015, a dentist in Portland who had paid off his house early, avoided credit cards, and saved aggressively. His net worth was $1.2 million, all in equity, no debt. His financial advisor suggested he was being foolish. "Leverage is how wealth is built," the advisor said. "Your money should work harder." Marcus ignored the advice. By 2024, his net worth had grown to $2.1 million through simple compounding. He collected interest instead of paying it. His $900,000 in bond holdings generated $45,000 annually passive income extracted from the same system that was extracting from Jennifer Caldwell. Same economy, same decade. Opposite sides of the ledger. Opposite outcomes. In 2024, global interest payments on $317 trillion in debt totaled approximately $15 trillion. That's $15 trillion flowing from borrowers to lenders in a single year. Not in a decade, in 1 year. The entire GDP of China extracted annually through interest payments. But here's where it gets uncomfortable. That $15 trillion doesn't flow evenly to all creditors. It concentrates. The top 1% globally captures approximately 40% of total interest income, $6 trillion annually flowing to 80 million people. The top 0.1% captures 20%, $3 trillion to 8 million people. The top 0.01%, just 800,000 people worldwide, captures 10%, which is $1.5 trillion annually. That's $1.9 million per person every year in interest income alone. Eleanor Vance was 78 years old in 2024, a third-generation member of a European banking family. She still remembered the exact moment her grandfather explained the family business. She was 12, sitting in his study in Geneva, surrounded by leather-bound ledgers. "We don't build things," he told her. "We don't sell things. We lend money, and money always comes back with friends." He showed her the family's bond portfolio, government debt from 7 nations, corporate debt from 40 companies, all generating interest that flowed into the family trust. "Your job," he said, "is to make sure the money keeps working." Eleanor never had a traditional job. She never needed one. The interest from her share of the family holdings exceeded $4 million annually extracted from borrowers across 3 continents who had no idea her family existed. Now, here's a question that reveals the architecture of the system. If you could trace every interest payment you've ever made, every mortgage payment, every credit card bill, every car loan, where would the money ultimately end up? The answer isn't a bank. Banks are intermediaries. The answer isn't the government. Governments are borrowers, not lenders. The answer is a remarkably small network of institutions and individuals who have positioned themselves on the creditor side of a system that requires everyone else to be debtors. The families who built this system didn't build it accidentally. There's a reason the Bank of England was created in 1694 as a private institution to lend money to the government. There's a reason the Federal Reserve was designed in 1913 with private bank ownership. There's a reason the system creates money through debt, but never creates the money to pay the interest on that debt. That architecture, the mathematical impossibility embedded in every loan, is what we need to understand next. We ended part 1 with a question about architecture, the mathematical impossibility embedded in every loan. The Bank of England was created in 1694 as a private institution. The Federal Reserve was designed in 1913 with private bank ownership. The system creates money through debt, but never creates the money to pay interest on that debt. Now let's understand exactly how that mechanism works, because once you see it, you'll never look at money the same way again. Most people think debt works like borrowing from a friend. You need $100. Your friend has $100. He lends it to you. When you repay $110, including interest, your friend gets his original money back plus $10 extra. The money existed before the loan. The loan just moved it around. This is not how the modern debt system works, not even close. When a government borrows money by issuing bonds, the money doesn't exist before the borrowing. The act of borrowing creates the money. Let me show you exactly how. The U.S. government needs $1 trillion. It issues treasury bonds, essentially IOUs, promising to repay with interest. The Federal Reserve announces it will buy $500 billion of those bonds. Commercial banks buy the other $500 billion. Here's the question: where does the Federal Reserve get $500 billion? It doesn't have it. It creates the money by typing numbers into a computer. The Federal Reserve's balance sheet increases by $500 billion in assets, the bonds, and $500 billion in liabilities, the money it created. The money didn't exist before. It exists now because of the bond purchase. The commercial banks do something similar through fractional reserve banking, creating money through lending that didn't exist before the loan. William Paterson was 42 years old in 1694, a Scottish merchant who understood something profound about money. He still remembered the exact moment the idea crystallized. He was watching the English government struggle to finance its war against France. The treasury was empty. Taxes couldn't be raised fast enough. And then Paterson saw the opportunity. What if a private bank could create money by lending it to the government? The government would get funding. The bank would get interest. And the money itself would come from nowhere, just ledger entries that everyone agreed to treat as real. Paterson founded the Bank of England on this principle. The bank lent $1.2 million to the government and in exchange received the exclusive right to issue currency. From that moment, the mechanism was set, private. Institutions would create money through debt, and governments would pay interest on money that was created from nothing. But here's the critical part that Paterson understood, and most people today still don't. Only the principal is ever created. The interest is not. Think about this carefully. If the government borrows $1 trillion at 5% interest, it must repay $1 trillion plus $50 billion in annual interest. But only $1 trillion was created. The $50 billion to pay interest must come from somewhere else. Where? From future borrowing, or from taxing the existing money supply. This creates a mathematical trap. Total debt always exceeds total money supply because interest is owed on debt but was never created. If the total money supply is $100 trillion, but total debt, including interest owed, is $120 trillion, it's mathematically impossible to repay all debt. The system requires perpetual growth in debt just to service existing debt. What most people get wrong about the debt system is this: they think debt is meant to be repaid. It isn't. The system is designed so that debt grows perpetually. Interest flows perpetually, and wealth transfers perpetually from borrowers to lenders. Repayment would end the game. The game is designed to never end. Remember Jennifer Caldwell from Part 1, the hospital administrator paying $23,000 annually in interest. Here's where her payments actually go. Her mortgage interest flows to bondholders who bought mortgage-backed securities. Her credit card interest flows to bank shareholders. Her car loan interest flows to the financial institutions that own her auto lender. If you could trace every dollar of her $23,000, you'd find it pooling in accounts held by pension funds, insurance companies, and wealthy individuals who hold debt instruments. Jennifer's labor converted to dollars extracted through interest accumulated elsewhere. Now let's talk about who actually controls the money creation process. The Federal Reserve is often described as a government institution. It isn't. The Federal Reserve is a private institution owned by member banks. The 12 regional Federal Reserve banks issue shares to member commercial banks. J.P. Morgan Chase, Bank of America Citigroup, Wells Fargo. These private banks own the Federal Reserve and receive a 6% annual dividend on their shares. When the Federal Reserve holds $5 trillion in government bonds and receives interest, that interest ultimately flows to the private banks that own the Federal Reserve. The public believes the Fed is part of the government. The legal structure tells a different story. Here's a question worth sitting with. If private banks own the institution that creates money, and that money is created through debt that requires interest, who designed the system to benefit whom? Thomas Reynolds was 63 in 2008, a career Federal Reserve economist who had spent 30 years inside the system. He still remembered the exact moment he understood the architecture he'd been serving. He was reviewing the Fed's response to the financial crisis, trillions in new money created to buy bonds from banks that had caused the crisis. We were bailing out our owners, he realized. The Fed was created by banks, owned by banks, and operated for banks. Everything else is public relations. Reynolds retired early. He never spoke publicly about his conclusions. Some systems are easier to leave than to reform. If you could see an organizational chart of global money creation, who creates it, who receives it first, who pays interest on it, you would see something resembling a pyramid. At the top, central banks, controlled by or connected to private banking interests. Below them, commercial banks that create money through lending. Below them, corporations that borrow to operate. At the bottom, households that borrow to live. Money is created at the top and lent downward. Interest flows from the bottom upward. The structure is not accidental. The system has been refined over centuries, but the core mechanism remains unchanged since William Paterson founded the Bank of England. Create money through debt, charge interest, collect perpetually. Margaret Chen was 34, an accountant in Singapore, who specialized in sovereign debt analysis. She still remembered the exact moment the pattern became undeniable. She was charting global debt growth since 1990, $40 trillion in 1990, $87 trillion in 2000, $142 trillion in 2010, $226 trillion in 2020, $317 trillion in 2025. The debt was doubling approximately every 10 years. It has to grow, she told a colleague. If new debt stops being created, there's no money to pay interest on existing debt. The system requires exponential growth, or it collapses. Her colleague asked how long that could continue. Margaret shrugged. Until it can't. Now here's the twist that most people miss. The people who designed this system understood exactly what they were creating. The founders of the Bank of England in 1694 knew that once the government borrowed $1.2 million, it could never fully repay because the interest owed would exceed the money supply. This wasn't a flaw they overlooked. This was the feature they were selling. Perpetual debt means perpetual interest income, and perpetual interest income means perpetual wealth transfer from borrowers to lenders forever. The system has operated for 330 years. The families who positioned themselves as creditors at the beginning have maintained that position across generations. And the mechanism they created now operates at $317 trillion scale, extracting $15 trillion annually. But every exponential curve has a limit. The system that requires perpetual growth eventually hits a wall. And understanding who sits on which side of the ledger when that wall approaches is the difference between catastrophe and opportunity. That wall is closer than most people realize. We ended part 2 with a wall approaching the limit that every exponential curve eventually hits. The system requires perpetual growth, but perpetual growth is impossible. Understanding who sits on which side of the ledger when that wall approaches is the difference between catastrophe and opportunity. Now let's see exactly who holds the $317 trillion, how they acquired it, and why the system guarantees they will own even more when it breaks. The public story about global debt is that everyone participates equally. Governments borrow for public services. Corporations borrow for growth. Households borrow for homes and education. Creditors are pension funds managing retirement savings for ordinary workers. It's a balanced ecosystem supposedly. Everyone borrows, everyone lends, everyone benefits. The reality is different. Let me show you who actually holds the debt. 4 categories of creditors own $317 trillion in global debt. Central banks hold approximately $25 trillion. Institutional investors, pension funds, insurance companies, mutual funds, hold approximately $120 trillion. Foreign governments and sovereign wealth funds hold approximately $40 trillion. And wealthy individuals hold approximately $130 trillion in direct debt holdings. But the question isn't who holds the paper. The question is who controls the institutions that hold the paper. Start with central banks. The Federal Reserve holds $5 trillion in U.S. government debt. The Bank of Japan holds $5 trillion in Japanese government debt. The European Central Bank holds $5 trillion in European government debt. These central banks receive billions annually in interest payments from taxpayers. But who owns the central banks? The Federal Reserve is owned by member banks: J.P. Morgan Chase, Bank of America, Citigroup, Wells Fargo. These private institutions receive 6% annual dividends on their Federal Reserve shares. When the Fed earns interest on government bonds, that interest ultimately flows to private banking shareholders. The public believes the Federal Reserve serves the nation. The ownership structure suggests it serves its owners. James Stillman was 49 in 1913, the president of National City Bank, which would become Citibank. He still remembered the exact moment he reviewed the final Federal Reserve Act before it passed Congress. He was sitting in a private rail car with 4 other bankers traveling to a secret meeting at Jekyll Island, Georgia. The legislation they helped draft would create a central bank owned by the very institutions it was supposed to regulate. "It's perfect," Stillman told his colleagues. "They'll think it's government. We'll know it's ours." The Federal Reserve was signed into law that December. 112 years later, the member banks still collect dividends. Now look at institutional investors, the $120 trillion held by pension funds, insurance companies, and mutual funds. Pension funds theoretically belong to workers. But workers don't control pension funds. Fund managers do. And fund managers are paid based on assets under management, not on returns to beneficiaries. The incentives are misaligned by design. Insurance companies are owned by shareholders. The top 10% of households own 89% of stocks and bonds. The insurance companies that hold trillions in debt are effectively controlled by the wealthy. Mutual funds like Vanguard, BlackRock, and State Street manage over $20 trillion in assets. Vanguard is theoretically owned by fund investors, but control rests with management. BlackRock and State Street are publicly traded with concentrated ownership among wealthy shareholders. 3 companies control assets larger than the GDP of every nation except the United States and China. Here's a question worth sitting with. If the same financial elite control the institutions that create money, the institutions that lend money, and the institutions that collect interest on money, is it really a market, or is it a mechanism? What most people get wrong about the debt system is this: they think creditors and debtors are randomly distributed, that anyone can be on either side based on choices and circumstances. The system is actually structured to ensure certain entities are always creditors and certain populations are always debtors. The architecture predetermines the outcome. Remember Eleanor Vance from Part 1, the 78-year-old European banking heir whose family has collected interest for generations. Her $4 million in annual interest income doesn't come from nowhere. It comes from the $23,000 annual interest payments made by people like Jennifer Caldwell, the hospital administrator, working until 10 a.m. every day just to service debt. Millions of Jennifers generate billions for thousands of Eleanors. The flow is one-directional, perpetual, and accelerating. Pause and consider the mathematics of compound interest across generations. The Rothschild family held approximately $2 billion in assets in 1850. They weren't industrialists building factories. They weren't inventors creating products. They were bankers who lent money and collected interest. Through 175 years of compound interest, reinvesting returns into more bonds, more loans, more debt instruments. The family's wealth is estimated at $500 billion to $1 trillion today. They didn't work for that money. The money worked for them, extracted annually from borrowers who did work. Heinrich Rothschild was 63 in 1875, reviewing the family's portfolio from their London office. He still remembered the exact moment he understood the family's true business. He was explaining their holdings to his 20-year-old nephew, walking through government bonds, from 7 nations railroad bonds, from 3 continents industrial loans across Europe. "We don't build the railroads," Heinrich said. We don't run the governments. We simply provide the money. And every year without fail, the money returns with more money attached. The nephew asked what happened if borrowers couldn't repay. Heinrich smiled. Then we acquire their assets. Either way, we grow. Now let me show you the annual extraction in concrete terms. In 2024, global interest payments on $317 trillion in debt totaled approximately $15 trillion. That's $15 trillion flowing from borrowers to creditors in a single year. Governments paid approximately $5 trillion in interest. That $5 trillion came from taxes paid by citizens. It went to bondholders. The U.S. government alone paid $900 billion in interest on its $36 trillion debt. $900 billion extracted from American taxpayers and delivered to creditors, many of whom are not American, some of whom are institutions controlled by wealthy families operating across generations. Corporations paid approximately $5 trillion in interest on $90 trillion in corporate debt. Where did that $5 trillion come from? From the difference between what corporations pay workers and what they charge consumers. Corporate interest payments are extracted from labor. Households paid approximately $3 trillion in interest on $60 trillion in household debt. A family earning $70,000 paying $15,000 in mortgage interest, $5,000 in credit card and auto loan interest, sends 29% of their income to creditors annually. If you could see the $15 trillion in annual interest payments visualized as a flow rivers of money streaming from billions of households, millions of corporations, and every government on Earth converging into increasingly narrow channels, you would see the largest wealth transfer mechanism in human history operating in real time. The top 0.01%, 800,000 people globally capture approximately $1.5 trillion of that annual flow. That's $1.9 million per person per year in interest income extracted from a system where 8 billion people are the payers. And here's the rage-inducing part. The system is designed to concentrate wealth during both expansion and collapse. During expansion, like the past 40 years, the wealthy collect interest on perpetually growing debt. Their wealth compounds. Their share of total assets increases. The mechanism extracts continuously. During collapse, when debt becomes unsustainable and defaults cascade, the wealthy don't lose. They convert their paper claims into hard assets at fire sale prices. Robert Mendelsohn was 54 in 2009, managing a private equity fund specializing in distressed assets. He still remembered the exact moment he understood how the game really worked. He was reviewing a portfolio of 3,000 homes purchased from bankrupt borrowers at 45 cents on the dollar. Families who had taken mortgages made payments for years, then defaulted in the crisis. Their homes now belonged to his fund. They paid until they couldn't, he told his partners. Then we took the house and kept the payments they'd already made. Within 5 years, those homes had recovered full value. His fund's investors, predominantly wealthy families and institutions, had doubled their money. The original homeowners became renters, many paying rent to companies owned by the same fund that bought their foreclosed property. This happened across America in 2008-2012. BlackRock's Invitation Homes subsidiary bought over 80,000 single-family homes from foreclosure. Homeownership rates dropped. Corporate landlord ownership spiked. The crisis didn't destroy wealth, it transferred wealth from defaulting borrowers to patient creditors with cash. Here's a question that reveals the architecture. If the same entities profit during expansion through interest and during collapse through asset acquisition, is the system designed to transfer wealth regardless of economic conditions? The system that created $317 trillion in debt is approaching a mathematical limit. Debt is 330% of GDP and growing at 7% annually. GDP grows at 3%. The gap widens every year. By 2035, debt could exceed 400% of GDP. At that level, interest payments alone would consume 40% of global economic output. Something must break. And when it does, the question isn't whether wealth transfers. The question is in which direction. The elite are already positioning for that moment. They're converting paper claims to hard assets. They're diversifying across currencies and jurisdictions. They're preparing for the three possible outcomes, and they're positioned to benefit from all of them. What are those three outcomes? And why does each one transfer wealth from the middle class to the top? We ended part 3 with the elite already positioning for what's coming. Converting paper claims to hard assets, diversifying across currencies and jurisdictions, preparing for three possible outcomes. Each outcome transfers wealth from the middle class to the top. Now let's examine those three outcomes. See who survives each scenario, and understand why the system ensures the same people win, regardless of which path unfolds. The $317 trillion in global debt is 330% of GDP. Debt grows at 7% annually. GDP grows at 3%. The math is inescapable by 2035, if current trends continue. Global debt will exceed 400% of GDP. At that level, interest payments alone would consume 40% of global economic output. Every dollar produced would need to be redirected to creditors before a single worker could be paid a single service, provided a single good consumed. Something breaks before we reach that point. The only questions are, what breaks, when it breaks, and who is destroyed when it does? There are three possible outcomes: default inflation or jubilee. Each has happened before. Each will happen again. And each transfers wealth in the same direction, upward. Let's start with default. When governments or corporations cannot service their debt, they default. Bondholders take losses. The financial system seizes. Credit freezes. Economic activity collapses. This is what happened in Argentina in 2001, in Greece in 2012, in countless countries throughout history. Maria Gonzalez was 41 in December 2001. A school teacher in Buenos Aires with 80,000 pesos in savings, her entire life's accumulation meant for retirement. She still remembered the exact moment the government announced the corralito, the freezing of all bank accounts. She stood outside her bank watching desperate people pound on locked doors. When the freeze lifted months later, her 80,000 pesos had been forcibly converted to $27,000 worth of devalued currency. 2/3 of her savings confiscated overnight. By 2011, Maria was still teaching, still living in the same apartment, but retirement had receded by 15 years. By 2024, at 64, she was still working. Her savings never recovered her future, defined by a crisis she didn't create and couldn't escape. Now contrast that with someone positioned differently during the same crisis. Eduardo Constantini was 55 in 2001, a real estate developer from one of Argentina's wealthiest families. He still remembered the exact moment he understood the crisis as opportunity. While Maria's savings were frozen, Eduardo held dollars in offshore accounts and hard assets across 3 continents. When the peso collapsed, he returned with his preserved dollars and bought distressed properties at 30 cents on the pre-crisis dollar. His art collection, purchased during the crisis from desperate sellers, would become the foundation of the Malba Museum. By 2011, his net worth had tripled. By 2024, the Constantini family remained among Argentina's richest, their wealth amplified by the same crisis that impoverished Maria. Same country, same crisis, opposite outcomes determined by which side of the ledger each person occupied. What most people get wrong about financial crises is this: they think crises destroy wealth. They don't. Crises transfer wealth. The money doesn't disappear, it moves. From those holding paper promises in local currency to those holding hard assets and foreign currency. From the unprepared to the prepared. From the many to the few. The second possible outcome is inflation. When governments cannot repay debt and cannot politically default, they inflate. They create money to pay obligations, devaluing the currency. The debt is technically repaid, but with money worth less than when it was borrowed. This is a hidden default, a default on purchasing power rather than principal. Germany in 1923 is the extreme example, but moderate inflation is the more common tool. If inflation runs at 8% annually while wages grow at 3%, real purchasing power erodes by 5% per year. Over a decade, that's 40% of middle-class wealth quietly transferred to asset holders, whose property stocks and commodities rise with inflation. Patricia Okonkwo was 38 in 2020, a nurse in Atlanta with $45,000 in savings and a fixed salary. She still remembered the exact moment she realized inflation was erasing her progress. She was reviewing her bank statements, watching her purchasing power decline month after month. Her savings earned 0.5% interest, while inflation ran at 8%. Each year, her $45,000 bought less. By 2024, her nominal savings had grown to $48,000, but inflation had reduced their real value to the equivalent of $35,000 in 2020 dollars. She was working harder, saving diligently, and falling behind. By 2034, if current patterns continue, Patricia's savings will have lost half their purchasing power, while she will have aged 10 years and moved no closer to financial security. Now contrast that with someone positioned for inflation. Richard Thornton was 52 in 2020, a wealth manager in Connecticut advising clients with $10 million or more. He still remembered the exact moment he repositioned portfolios for inflation. It was March 2020, watching the Federal Reserve announce unlimited quantitative easing. "They're going to print," he told his team, "trillions, and that means everything priced in dollars gets more expensive." He moved client portfolios into real estate commodities and inflation-protected securities. By 2024, his clients' portfolios had grown 45% in real terms. By 2034, if inflation continues, their wealth will have doubled while Patricia's savings continue eroding. Richard's clients didn't create value, they positioned on the right side of a monetary policy that transferred wealth from savers to asset owners. Remember Jennifer Caldwell from Part 1, the hospital administrator paying $23,000 annually in interest. Her situation gets worse under inflation. Her debt doesn't inflate away because her mortgage is fixed, but her real wages decline while the assets she's paying for appreciate in nominal terms. She pays more in real effort for an asset that costs her creditors less in real terms. The system extracts from her in both directions. The third possible outcome is debt jubilee, a coordinated cancellation of debt. This sounds radical, but it has historical precedent. Ancient Mesopotamian kings declared jubilees. Medieval European monarchs defaulted on debts to foreign bankers. The modern equivalent would be coordinated, international debt restructuring, wiping clean unsustainable obligations. Here's the twist that most people miss. Even jubilees benefit the wealthy. When debt is canceled, creditors lose paper claims. But sophisticated creditors don't hold paper claims they've already converted to hard assets. A jubilee wipes out the savings of middle-class bondholders, including pension funds, while leaving real estate commodities and productive assets untouched. The wealthy emerge owning the same assets they owned before, but the competing claims against those assets have been erased. If you could see a visualization of wealth distribution before and after each type of crisis, default inflation or jubilee, you would see the same pattern. The middle compressed, the bottom expanded, the top preserved or enhanced. The mechanism of crisis doesn't determine who wins. The positioning before crisis determines who wins. And the same families and institutions have positioned correctly for centuries. Here's a question worth sitting with. If every possible outcome of the debt system transfers wealth upward, is the system designed to produce that outcome, regardless of circumstances? The trajectory for the next decade is not difficult to project. Global debt will continue growing because the system requires it. Interest payments will consume increasing portions of economic output. Governments will borrow to pay interest on previous borrowing. The spiral accelerates. At some point, perhaps 2028, perhaps 2032, perhaps later. A trigger event forces one of the three outcomes. It might be a major government default. It might be a currency crisis. It might be a coordinated policy response to unsustainable debt levels. When that happens, the average household holding debt, local currency savings, and undiversified assets will experience significant wealth destruction. The institutions and families holding hard assets, multiple currencies, and geographically diversified holdings will experience wealth preservation and expansion. The system that created $317 trillion in debt doesn't collapse cleanly. It extracts until it can't, then restructures to continue extracting. The mechanism is perpetual. Only the faces change. Remember Eleanor Vance from Part 1, the banking heir whose family has collected interest for generations. Her family survived the Napoleonic Wars, 2 world wars, the Great Depression, the 2008 crisis, and every monetary disruption of the past 2 centuries. They'll survive whatever comes next. They always do. Because they designed the system, and they understand its architecture. The question isn't whether the system continues transferring wealth. That's guaranteed by its design. The question is what you do with this understanding. That question brings us to the present moment and to what, if anything, can be done. We ended Part 4 with a question. What do you do with this understanding? The system guarantees wealth transfer regardless of which outcome unfolds. The mechanism is perpetual. Only the faces change. Now let's bring this to the present moment, to where you stand in this system, to what the pattern reveals, and to the question that matters most. The debt system we've traced through this video isn't ancient history. It's operating right now. In 2024, global debt grew by $12 trillion. In 2025, it will grow by more. The $317 trillion figure I mentioned at the start is already outdated. The number increases by roughly $1.5 trillion every month. By the time you finish this video, global debt will have grown by approximately $50 million. The mechanism William Patterson designed in 1694 is the same mechanism extracting wealth today. Create money through debt. Charge interest that was never created. Collect perpetually. The architecture hasn't changed in 330 years. Only the scale has changed. Let me return to where we started. Remember Jennifer Caldwell, the hospital administrator in Ohio, sitting at her kitchen table at 2 a.m., calculating that $444,000 in household debt required $23,000 annually in interest. Let me tell you where her trajectory leads. If Jennifer maintains her current income and debt levels, she will pay approximately $690,000 in total interest over her lifetime. Her $287,000 mortgage will cost her $516,000 in total payments. Her husband's $84,000 in student loans will cost $147,000 before they're paid. She will work approximately 11,500 hours, 5.5 years of full-time labor, just to service interest. Not principal. Interest. That time, that labor, that life energy flows to creditors, who will reinvest it into instruments that extract from the next generation of borrowers. By 2034, Jennifer will be 53 years old. If nothing changes, her household debt will have decreased to approximately $180,000, still substantial, still extracting. She will have paid another $230,000 in interest over that decade. Her retirement savings, depleted by debt service, will be insufficient for the retirement she once imagined. The system will have extracted from her for 30 years, and she will face 20 more years of extraction before the mortgage finally ends. Now contrast that with Marcus Webb, the Portland dentist who avoided debt and positioned himself as a creditor. By 2034, Marcus will be 61 years old. His bond portfolio, compounding at historical averages, will exceed $1.8 million. His annual interest income will approach $90,000 passive extraction from the same system that extracts from Jennifer. He doesn't work for that money. Borrowers work for it. The system delivers it to him because he positioned on the creditor side. Same economy, same decade, same system. One person pays. One person collects. The architecture determines the outcome. If you could see a chart showing the cumulative interest paid by the bottom 50% of households versus the cumulative interest received by the top 1%, you would see two lines diverging exponentially, one descending into deeper extraction, one ascending into greater accumulation. The gap widens every year. The mechanism guarantees it. Here's the unexpected twist that most people miss. Awareness doesn't automatically change your position in the system. Understanding that the system extracts doesn't stop it from extracting. Knowing the mechanism doesn't exempt you from it. Every mortgage payment still flows upward. Every tax dollar still services government debt. Every purchase still includes embedded interest costs from corporate borrowing. You cannot opt out of a system that encompasses all economic activity. But understanding does change what's possible. Here's a framework, not financial advice, not predictions, just questions worth asking. First, which side of the ledger are you on? Not where you think you are or where you wish you were. Where does the math actually place you? Are you paying more interest than you receive? Are your assets growing faster than your obligations? The honest answer reveals your position in the mechanism. Second, when the next crisis comes, and it will come, are you positioned like Maria Gonzalez with savings in local currency and no diversification? Or are you positioned like those who converted paper claims to hard assets before the crisis arrived? Third, every financial decision you make either moves you toward the creditor side or deeper into the debtor side. Which direction are your decisions taking you? These questions don't have universal answers. They have personal answers that only you can determine. Remember Eleanor Vance, the banking heir whose grandfather explained that money always comes back with friends. Her family's position wasn't luck. It was architecture understood across generations. They didn't predict crises, they positioned for all crises. They understood the system because their ancestors helped build it. The signature truth of this entire video is simple: debt is not a financial instrument. Debt is a wealth transfer mechanism. Every dollar of interest flowing from borrowers to creditors is a dollar of labor converted to passive income. Every generation of debtors funds another generation of creditors. The mechanism operates continuously, invisibly embedded in every transaction. This video wasn't about conspiracy. The system isn't secret. It's public law, public policy, public institutions. The Federal Reserve's ownership structure is documented. Interest payment flows are recorded. The mathematics of debt exceeding money supply is elementary arithmetic. Nothing I've shown you is hidden. It's simply not discussed. The $317 trillion question, who holds the other end, has an answer. The answer is a small global elite operating through central banks. They influence institutions, they control and direct holdings they manage. They are creditors to everyone else. And the interest payments from 8 billion people to a few million is the largest wealth transfer in human history, happening every single day. Here's a question worth sitting with as you return to your life after this video. The system extracted $15 trillion in interest payments last year. It will extract more this year. It will extract more next year. That extraction will continue until something fundamental changes, either the system restructures or you change your position within it. The pattern has repeated for 330 years. The families who positioned as creditors in 1694 still benefit today. The mechanism William Patterson designed still operates at planetary scale. Understanding changes nothing by itself. Only action changes position, and position determines whether you spend your life paying interest or collecting it. The $317 trillion debt system has a simple question at its core, a question that every person must eventually answer. Which side of the ledger do you want to be on when the music stops?